Hi, this is Diane Kennedy, and I'm going to do a different kind of blog entry today. Today I want to show you a video of how to take a deduction for a home office. I've got to say, this is one of the things that I talk about more than probably any other item when I'm doing seminars, taking questions, or with my new clients. It's how easy it is to take a home office deduction. First of all, there's two rules. You need to exclusively have the space for your office. So I'm starting off with one corner in my home office, and this is a new house we've just moved into. It's not new, it's new to us. And the person before me was actually a best-selling author, and she had the place already set up for her office. I'm guessing this might have been a dining room or something at some past life, and that's why we have this built-in in the corner that's painted purple. Now, if I were taking a space and converting it to my business, let's say I was taking a bedroom, I might have a closet and then do some work in it to put shelves in it, or maybe create a desk or do something else with that. The cost associated with that would be a direct one-for-one expense. In other words, if it cost me $500 to put shelves in, then that's a deduction for the business. In this case, I have a purple built-in that I may paint. So if that happens, then the cost of the paint and the cost of the labor, if I don't do it myself, are going to be a deduction for the business. Now, as we pan around, you can see a couple of more things that came with the property. These are some shelving units, or modular shelving units that are there. Now, if I didn't have those and I wanted to buy something like that, again, that would be a direct expense. Remember, this is an expense that goes directly against your business. So it's important to keep track of it. Additionally, we might have people that, as you're just starting off, might take an old table or put something in that you had personally and you want to use it in the office. In this case, this is just a really old cart, tea cart, and it's a great place to put projects I'm working on. It also folds up so it has leaves so it can be another table. That I would then say is I would take the fair market value of that property, and it would be a deduction for the business. I've contributed it, so the company ends up paying me for it at the fair market value, and then that becomes income to me, or it becomes not income for me, but a reimbursement, but it's an expense for the business. That's probably one of the mistakes people make when they first start a business, is they forget to count all the things that they contributed. I'm not sure right now where we're focusing out. We're looking at the desk. I can see this. My son's helping me today. And you can see I kind of got a mess. Hey, this is exactly how I work. And what you're seeing is I've got a phone, I've got my computer. You know, the computer is a couple, 3 years old by now, and it happens with technology. If I were to try to get the fair market value on something like that, it'd probably be $10. I mean, what on earth do used computers and technology go for anymore? But reality is, when you first buy them, if this was a new computer, it's not, but if it was, I'd be able to have a number of choices in how I take a deduction. I might write the whole thing off right away with what's called a Section 179. For 2009, you can take $250,000 in a Section 179. Or I might decide instead that I want to take bonus depreciation. Bonus depreciation lets me take 50% of the value in the first year on top of the regular depreciation I take. I need to note, you're not getting extra depreciation with this method. Instead, you're front-end loading it, which can give you additional write-offs. Now, the difference I might make between doing it, the Section 179 versus the bonus depreciation, is that Section 179 can't take me to a net operating loss, but the bonus depreciation can. And there are some times when you want to maximize the net operating loss so that you can take carrybacks to previous years or carry forwards of loss to future income years. I think by now we might be focusing on my view, which is why we've moved to this place. We've got an amazing ocean view. We're right on the ocean. And while we're just looking at the ocean rather than my messy desk, let me talk a little bit more on how you take the home office deduction. I pointed out some of the items that are actually fixed expenses. Additionally, something that you might have contributed to the company when you first started. I showed an old table, but it could also be something like computers, cell phones, desks, chairs, filing cabinets. Make sure you make a list of all of those and then use the fair market value. You'll find typically that furniture will have some kind of value still left on it, whereas equipment rarely does. I mean, you know, what on earth would somebody pay you for a 3-year-old computer anymore? So that's the thing to remember as you're putting that together. But additionally, besides the direct expenses of anything that goes into that space, you also get to take a deduction for indirect expenses. Examples of that would be the costs of your home itself. If you're paying rent, it'd be your rent. If you've got a payment, it'd be your mortgage interest, property tax, your insurance, homeowners dues, utilities, maintenance costs, cleaning services. All of those, you get to take a percentage of a deduction. The percentage is determined by the square footage of your office in comparison to the total square footage of your home. So let's say you have a 2,500 square foot home and you have a home office that's 250 square feet. That'd be 10%. So that means 10% of your mortgage, your property tax, your utilities, your insurance, etc., are an indirect home office expense. One other point, people ask, well, where do I take the deduction? And the answer is, my favorite 2-word answer to everything, it depends. In this case, what we're looking at is what type of business structure you have. If you're operating as a sole proprietorship or a single member LLC that is not elected how it wants to be taxed, then you have to file a form for the home office, and it's a separate attachment as part of your Schedule C. If you're operating as an S corporation, you actually set up what's called an accountable plan, and you then as a shareholder are reimbursed for the costs of the home office, and it goes inside the S corporation, reducing the amount of income that you then pay tax on. If you've got a C corporation, you do it completely differently. In that case, the C corporation pays you a fair market value rent, and the income is then offset by that 10% or whatever percentage it is in your case of all of the indirect expenses. And remember, of course, all of the direct expenses are on top of that. The direct are the things you contributed and work that you did specifically in that space. I hope that's been helpful in how you take the home office deduction. Don't be afraid of this. Remember, there's just 2 rules. It needs to be exclusively used for the business, and you need to regularly do some kind of business in the space. Thanks for joining me. This is Diane Kennedy.